Hello everyone, this is Victor here. Welcome to the Intelligent Investor channel, where you learn about stock investing and personal finance that will help you become a great investor. In today's video, I'm going to talk about the Holding Foreign Companies Accountable Act, and I'm going to talk about why I believe there's a small chance of Chinese companies getting delisted within the next 3 years. These are the topics I'm going to cover in this video. First, what exactly is the Holding Foreign Companies Accountable Act? Second, what is the worst case scenario if Chinese companies are delisted? Third, how many Chinese companies are listed in the US and what is their total market value compared with the entire US stock market? Fourth, what is the best case or a more realistic case scenario? Fifth, which companies are affected by the Holding Foreign Companies Accountable Act the most? Sixth, summary, why I believe there's a small chance of Chinese companies getting delisted, and what should you do going forward if you're planning to invest in Chinese stocks. If you like this video, hit the like button and subscribe. I will continue to make many great videos about stock investing and personal finance every week that will help you become a great investor. Let's start. First, what is the Holding Foreign Companies Accountable Act? The Holding Foreign Companies Accountable Act, or HFCA Act, is a new bill that was unanimously passed by the US Senate and the US House. This bill forces Chinese companies listed in the US Stock Exchange to comply with US securities regulations and to be audited by the Public Company Accounting Oversight Board, or PCAOB, for 3 consecutive years. If the Chinese company fails to be audited by PCAOB within 3 years, and if the company fails to prove that it is not owned or controlled by the Chinese government, it will be delisted from the national US stock exchange as well as even the over-the-counter networks. Now, here's a summary from the Congress website. This bill requires certain issuers of securities to establish that they are not owned or controlled by a foreign government. Specifically, an issuer must make this certification if the Public Company Accounting Oversight Board is unable to audit specified reports because the issuer has retained a foreign public accounting firm not subject to inspection by the board. Furthermore, if the board is unable to inspect the issuer's public accounting firm for 3 consecutive years, the issuer's securities are banned from trade on a national exchange or through other methods. There are several important parts of this bill. I will try my best to explain them based on my understanding. First, the Holding Foreign Companies Accountable Act, or HFCA Act, is an amendment to the Sarbanes-Oxley Act, or SOX Act of 2002. The Sarbanes-Oxley Act of 2002 was created to protect shareholders from corporations' fraudulent financial reporting, such as overstating the company's sales numbers or creating fake sales numbers by selling to the company's subsidiaries. The Sarbanes-Oxley Act also created the Public Company Accounting Oversight Board, or PCAOB, to oversee all auditing companies of public companies in the US. The big 4 auditing firms that are under PCAOB's watch in the US are Ernst & Young, PwC, KPMG, and Deloitte. Second, under the Holding Foreign Companies Accountable Act, PCAOB will need to be able to audit the Chinese companies' audited work from the local auditor in China or Hong Kong. So for example, if the Chinese company uses a global accounting firm such as PwC that has offices in both US and Hong Kong, PCAOB will still need to audit the PwC's audited work. But however, here is the problem. Chinese regulators restrict foreign regulators such as the US PCAOB from auditing Chinese companies because of national security concerns. Now third, The HFCA Act requires the Chinese company to disclose it's not owned or controlled by a foreign government. This will likely be an issue for many Chinese public companies traded in the US exchange. Fourth, if PCAOB cannot audit the Chinese company for 3 consecutive years, the Chinese company stock will be delisted from any US stock exchange, including over-the-counter networks. This is another problem. Fifth, the HFCA Act will allow the Chinese company to be traded in the US stock exchange again once PCAOB audits the company's audited work from the local auditor in China. Again, this is to make sure the Chinese company complies with US securities regulations and to make sure the company is not owned or controlled by a foreign government. Second, what is the worst case scenario if Chinese stocks are delisted? Now, to put it simply, the worst case scenario is that Chinese companies such as Alibaba, JD.com, Pinduoduo, NIO may get delisted if they cannot be audited by PCAOB within 3 years. This means their stock values will likely drop a lot if they're delisted within 3 years. Now here's the important part. According to the Congress website, the HFCA bill states this: if the Commission determines that a covered issuer has 3 consecutive non-inspection years, the Commission shall prohibit the securities of the covered issuer from being traded on a national securities exchange or through any other method that is within the jurisdiction of the Commission to regulate, including through the method of trading that is commonly referred to the over-the-counter trading of securities. The HFCA Act will not allow the Chinese stock to be traded even over the counter after the stock getting delisted from the US stock exchange. I think this is a huge problem because US investors will be forced to sell Chinese stocks at a much lower price if the Chinese stocks are delisted. The Chinese companies may need to buy out investor shares at a much lower price. And investor shares may also need to be transferred to the Hong Kong Stock Exchange or the China Stock Exchange. This will be another problem because not all brokers have access to the Hong Kong Stock Exchange and the Chinese Stock Exchange. Again, if the Chinese stocks get delisted, the worst case scenario is that the stock values will drop a lot because many investors will rush to selling their stocks all at once. Third, you may wonder, how many Chinese companies are listed in the US and what is their total market value compared with the entire US stock market? So according to the US-China Economic and Security website here, as of October 2nd, 2020, there were 217 Chinese companies listed on this US exchange with a total market cap of 2.2 trillion. This table shows the biggest Chinese companies listed in the US stock exchange, including Alibaba, China Life Insurance, China Mobile, JD.com, PetroChina, KE Holdings, and China Petroleum. So in comparison, according to CBS Research, the entire US stock market value is 36 trillion as of September 30th, 2020. Now, what does this mean to you? It means Chinese stocks in the US of around 2.2 trillion of market cap in total is about 6% of the entire US stock market of 36 trillion in total. If Chinese stocks are delisted within the next 3 years because they cannot be audited by PCAOB, 6% of the entire US stock market or 2.2 trillion should be in theory wiped out or be transferred to the Hong Kong or Chinese stock exchange. Realistically, I don't think that's going to happen. This will hurt many US investors and large institutional investors that have invested in Chinese stocks, than protecting in US investors from Chinese companies that may have fraudulent financial reporting. I don't think the HFCA Act will force all or most of the Chinese companies out of the US stock exchange. If they cannot be audited by PCAOB, the economic impact to US investors will be much bigger than the benefits of delisting Chinese stocks. Fourth, what is the best case or a more realistic case scenario going forward? The best case scenario is that US regulators and Chinese regulators will reach a compromise or an agreement to allow Chinese companies to continue to be listed in the US stock exchange. Now, I believe both US and Chinese regulators will eventually reach an agreement to allow PCAOB to audit Chinese companies' financials to a certain limited degree, or at least allow Chinese stocks to be traded over the counter if they're delisted from the major US stock exchange. As of October 2nd, 2020, there were 217 Chinese companies listed in the US stock exchange with a total market cap of 2.2 trillion. That's about 6% of the entire US stock market. I believe there's a small chance of US regulators forcing Chinese companies to be delisted because the economic impact will be huge to many US investors. Now, I said this earlier, if most of the Chinese companies are delisted because they cannot be audited by PCAOB within 3 years due to the Chinese regulations, US investors will lose a lot of money, probably billions of dollars. The economic impact on US investors will be much more than the benefits of delisting Chinese stocks. This may be an exaggeration, but just imagine losing 6% of the entire US stock market value because Chinese companies are forced to delist their stocks in the US and they're forced to relist their stocks in the Hong Kong Stock Exchange and the Chinese Stock Exchange. One positive thing is that Chinese companies will have 3 years to comply with the HFCA Act, and in my opinion, that is a lot of time. This will give the US and Chinese regulators 3 years to come up with a compromise. One solution I can think of is to allow Chinese companies to stay in the US stock exchange as long as they are audited by the Big Four accounting firms, including Ernst & Young, PwC, KPMG, and Deloitte. Many of these large Chinese companies are already audited by the Big Four accounting firms. So, for example, Alibaba is already using PwC Hong Kong to audit the company's financials. And according to Alibaba's Q4 2020 earnings release, Alibaba is also following the US GAAP accounting principles. Fifth, which companies are affected the most by the Holding Foreign Companies Accountable Act? Personally, I believe smaller and less established Chinese companies listed in the US will be impacted by the HFCA Act the most. This is because the smaller and less established Chinese companies have a high chance of overstating or even faking their sales numbers in order to attract more investors. These companies tend to have very high revenue growth while they're still losing money every quarter. So here is one example. According to Hindenburg Research, published on November 30th, 2020, Hindenburg believes Kandi Technologies Group, another Chinese electric vehicle company listed in the US stock exchange, is falsifying sales numbers by selling cars to undisclosed affiliates. The report states, "We amassed Kandi's unnamed top customers and found that almost 64% of Kandi's last 12 months sales have been to undisclosed related parties." The company's largest customer, representing 55% of last 12 months sales, share a phone number with a Kandi subsidiary and share an executive with Kandi. Then the report also states Kandi's current auditor, Markham, was just handed a 3-year ban from auditing Chinese companies by the Public Company Accounting Oversight Board, PCAOB. So rather than firing the auditor, Candy just reported its intention to renew the engagement. So which Chinese companies are affected the least by the HFCA Act? I believe the large and well-established Chinese companies such as Alibaba and JD.com are affected the least by the HFCA Act. I believe they have a much higher chance of staying in the US stock exchange because their business models and their financials are much more established. They have more reasonable revenue and net profit growth each year, and they're using more reputable auditing firms such as the Big Four accounting firms, Ernst & Young, PwC, KPMG, and Deloitte. Summary, why I believe there's a small chance of Chinese companies getting delisted, and what should you do going forward if you're investing in Chinese stocks. Personally, I believe there's a small chance of Chinese companies getting delisted for these reasons. First, the Holding Foreign Companies Accountable Act will give Chinese companies 3 years to comply with US securities regulations and to be audited by PCAOB. Second, during these 3 years, I believe US and Chinese regulators will eventually find a compromise to allow PCAOB to audit Chinese companies' audited work to a certain limited degree. And of course, it will be a compromise between US and China securities regulators, because China currently does not allow foreign regulators auditing Chinese companies due to China's national security concerns. Third, in my opinion, it does not make sense to delist 217 Chinese companies listed in the US stock exchange, since their total market cap size is 2.2 trillion, representing about 6% of the entire US stock market. I believe delisting Chinese companies, if they cannot be audited by PCAOB within 2 years, will have a much greater economic impact on US investors. Retail investors, Wall Street, and large institutional investors will lose billions of dollars if the majority of the Chinese companies are delisted within the next 3 years. Fourth, if Chinese companies are forced to be delisted within the next 3 years, Chinese companies will no longer want to list their IPOs to raise capital in the US, but instead they will list their IPOs in the Hong Kong Stock Exchange or the Chinese Stock Exchange, such as the Shanghai Stock Exchange or the Shenzhen Stock Exchange. I believe the US will want to maintain its leadership in the IPO market instead of letting China become the market leader in the IPO market. Now, what should you do if you're investing in Chinese stocks? Personally, I will only have a small amount of capital invested in Chinese stocks to reduce risks, even though I believe that there's a small chance of delisting Chinese companies within the next 3 years. For example, I only have 7% of my stock portfolio invested in Alibaba and Tencent Holdings. I have a long position in them for many years. They're the 2 largest and most profitable companies in China. They're also near monopolies. Personally, I will stay away from the smaller and less established Chinese companies because I believe they will be impacted by the HFCA Act the most. Now, if you like this video, hit the like button and subscribe. I will continue to make many great videos about stock investing and personal finance that will help you become a great investor. This is Victor from the Intelligent Investor channel. Thank you for watching.